A government announces it is borrowing another $1 trillion. Headlines fly, politicians argue, markets barely blink. Somewhere in the background, a quiet question goes unanswered. When the government borrows that money, who actually gets paid? Not in theory, not in textbooks, in real life. Because here is the uncomfortable truth. Governments do not borrow from a giant vault labeled taxpayers. They borrow from a system that most people never see, never vote on, and never fully understand. And right now, that system is bigger and more powerful. This matters today because government debt is no longer a future problem. It is the present. The United States alone adds roughly $1 trillion of debt every few months. Many countries are not far behind. Yet daily life feels oddly normal. No alarms, no shutdown, just more borrowing. So where does the money go, and who is quietly collecting the checks? Let us start simple. When a government needs money, it sells IOUs. These are called bonds. A bond is just a promise. Lend me money today, I will pay you back later with interest. That sounds harmless, almost boring. But here's where the story gets interesting. The government does not sell these IOUs to regular people first. It sells them to a small group of powerful buyers: banks, investment funds, pension funds, insurance companies, and sometimes central banks. Think of this group as the first stop, the front row. These buyers hand over cash and receive government bonds in return. That cash pays for everything from roads to wars to social programs. The bonds sit quietly on balance sheets, earning interest. So, who gets paid first? The institutions with enough money and access to buy government debt in bulk. Now, let us follow the money one step deeper. Those banks and funds did not magically create that cash. Much of it comes from deposits, your savings, your retirement account, your insurance premiums, pooled together, repackaged, lent upward to the government. You are not directly lending to the government, but your money often is, and the institutions in the middle take a cut. They earn interest on the bonds. They earn fees for trading them. They use them as collateral to borrow even more money. One promise stacked on top of another. Here's the irony. Government bonds are called safe assets, the safest thing in finance. So safe that the entire financial system is built on them. Banks use them to prove they're stable. Central banks use them to control interest rates. Investors use them as a parking lot for trillions of dollars. Which means governments are not just borrowing money, they're feeding the engine that keeps modern finance running. Now comes the part most people miss. When a government pays interest on its debt, it doesn't send one big check to a single lender. It sends millions of small payments across the system, to banks, to funds, to pension plans, to foreign governments, to central banks. Yes, foreign governments. Countries lend to each other all the time. China holds U.S. debt. Japan holds U.S. debt. European funds hold U.S. debt. American funds hold foreign debt. It's a web of promises that crosses borders and politics. So when politicians say, we owe money, the real answer is, we owe it to ourselves and to everyone else at the same time. But here's where the math gets uncomfortable. The interest doesn't disappear, it compounds. If a government borrows $1 trillion at a modest interest rate, it owes tens of billions every year just to keep that debt alive, not to reduce it, just to maintain it. Those payments go out before anything else gets discussed, before new programs, before tax cuts, before repairs. Debt service is not optional, which means a growing share of government budgets goes to paying past promises instead of present needs, quietly, automatically, no vote required. Now let's talk about central banks, because this is where things start to feel unreal. Sometimes the biggest buyer of government debt is the government itself, or more accurately, its central bank. The central bank creates new money and uses it to buy government bonds. This is often described as stimulus or support, but strip away the language and it looks like this. The government borrows money that did not exist before, then pays interest on it. Who receives that interest? The central bank, which usually sends profits back to the government. It sounds circular, and it is. This is how debt can grow without immediate collapse. New money smooths the pressure for a while. But there's a cost: inflation, asset bubbles, a system that rewards those closest to the money creation process. And that brings us to the quiet winners. If you own bonds, you get paid. If you manage money, you get paid. If you trade debt, you get paid. If you have assets that rise when new money enters the system, you benefit. If you rely mostly on wages and savings, the story is different. This is why borrowing trillions feels painless to some and suffocating to others. The hype says government debt is just numbers on a screen, that we can always roll it over, that it doesn't matter who holds it. Reality is more fragile. Debt ties the future to the past. It locks in obligations. It shifts power toward creditors. It limits choices. And the bigger the debt, the more important those creditors become. Zoom out and the picture gets even bigger. Entire markets depend on governments never missing a payment. Retirement systems, banks, insurance companies, global trade. If confidence cracks, everything shakes. That's why governments keep borrowing, not because it's free, but because stopping would be more dangerous in the short term. So who actually gets paid when governments borrow trillions? Institutions, investors, foreign states, financial systems that run on promises, and indirectly, all of us who are plugged into that system, whether we like it or not. The final question is not who gets paid today, it's who decides the price tomorrow, and what happens when the system that runs on trust starts asking harder questions than politicians are ready to answer.